All right, we are live. So welcome back to Dapp University. So today we got a lot to talk about in our live stream. We're going to talk about the new Ethereum fork that has been exploited by replay attacks. All right, what that means and what you should know in this video, okay? We're going to look at that. We're going to look at a lot of other news updates that have happened in the space since our live stream on Friday. Again, we do these live streams Monday through Friday on this channel. Just subscribe, turn on notifications. You're going to find out about those whenever we go live. We're going to answer some of your questions, take a look at the quick look at the crypto markets, and a whole lot more. So if you're new around here, hey, I'm Gregory, and on this channel, I turn you into a blockchain master. So if that's something that you're interested in, then smash that like button down below for the YouTube algorithm and subscribe to this channel. And if you want to become a blockchain master step-by-step, start to finish, land your first blockchain job, I can show you how to do that over at dappuniversity.com/bootcamp. All right, so we got people jumping in the chat here. We got Dale, Coltraz, Kodia, Coachap, Nathaniel, Jay Lee, Automatic Beats, Robert, Venture Warrior, ENIAC, Grieg. Welcome. All right, so let's jump into this. So Ethereum just underwent the biggest upgrade of its entire history since its launch last week, okay, with the Ethereum merge, where we turned on proof of stake. Basically, we turned off proof of work, you know, the mining, the consensus mechanism for the Ethereum chain, which is exactly what Bitcoin has, and we switched to proof of stake, okay? This was a huge success, and as a result of this fork, okay, or as a result of this merge, we had a couple of chain forks. That's kind of confusing. What's a merge versus a fork? Well, in this case, basically, we had two blockchains running, the beacon chain and the main chain. Those merged together, okay, to create this new version of Ethereum that runs proof of stake. But there are a few forks, okay, which basically meant that the same common chain, well, for recap here, merge is two things becoming one. A fork is one thing becoming two, or even more, like a fork in the road. So basically, we had a couple different blockchains stay behind to keep proof of work running because, you know, we had a lot of miners on top of Ethereum. A lot of those wanted to essentially keep a chain where their, services were actually still in demand because, of course, you can't mine the new chain anymore. Things like the Ethereum proof of work fork, all right, which is one of the most popular ones, okay, ETH-W or Ethereum proof of work. And we've been talking about this for quite some time on this channel. There's lots of people who transferred their ETH to the Ethereum main chain to get free coins whenever this chain forked, okay? Basically, if you held ETH on the main chain prior to a certain time and you weren't deposited into certain applications and things like that, you'd essentially get brand new tokens because, you know, if you have funds on that chain, when they fork, they just take a copy of the state, and then that's, you know, an exact copy after they move to a new blockchain, with some exceptions, which they outlined in their sort of original manifesto, I should say. So anyways, last week, before this was really happening, we took a look at some warnings that were raised by the community, talking about some potential security vulnerabilities with the new Ethereum proof of work fork, particularly around replay attacks, okay? So what is that? Well, replay attack is essentially where you can, take a transaction and do it twice. So if it happens on one chain, essentially copying it and replaying it on a different chain, okay? So last week we raised some concerns about this because essentially they have this chain ID, which is just a number that if you're writing software tells you, it's a unique identifier to tell you which blockchain you're actually using, because with Ethereum, there's so many different EVM compatible chains. Or even if you're just using Ethereum alone, you have the Ethereum mainnet and you have test networks, and using this unique identifier is sort of this thing that just lets the software know which of these networks you're actually connected to. So they changed, this chain ID, which when we saw this happening, we raised some concerns that could potentially cause some issues here, replay attacks being one of those things. So, we just got notice that it happened, okay? So we're starting to see some replay attacks happen on the ETH-W chain. Let's look at some of the details here. So basically, the Ethereum proof of work version that continued to run proof of work experienced a replay exploit over the weekend due to a faulty third-party contract, okay? So basically, the developers of Ethereum proof of work were alerted to issues and immediately took steps to rectify the problem. So basically, this has happened after the merge, like I was talking about. And the replay attack, like I was saying, is basically the same transaction being duplicated on both chains when they're not supposed to. Because at the end of the day, whenever you're doing a transaction, like let's say you are going to send cryptocurrency from one account to another, you're going to trade a token on Uniswap, buy something on an NFT on OpenSea. What you're doing is you're just creating a set of instructions that the blockchain is going to follow. It might be like, hey, just send ETH. It might be, hey, call this function on a smart contract. And really, that's just going to be some data that you're going to send to the chain, and you're going to sign it with your private key. That's the whole point of digital signatures. And that just authorizes that you did that, okay? And that it will essentially, the blockchain will just do that on your behalf, okay? So whenever you have a replay exploit, you can essentially just copy the same instructions and then move them over to a different environment. You can also change things where if there's, changing the function signature is also one thing that you can do. And when you have two blockchains that have a common history, and a common state for that reason, then there's a huge opportunity for this to happen, which opens the door for all kinds of things like double spend, et cetera, et cetera. So basically, this means if a user transacted on Ethereum proof of work, the same was executed on Ethereum, which eventually allows attackers to illicitly trick the smart contract into releasing tokens from one chain, even as actual transactions were executed, even as the actual transaction was executed on a different chain. So in this case, the attacker was using the Omni bridge of the Gnosis network to conduct the exploit. Some 200 weighted Ether was transferred through the bridge on Saturday. That the same transaction was replayed on the proof of work chain. So basically, they were able to get 200 weighted ETH. So faulty data from the Ethereum proof of work network's chain ID used by a contract caused the issue. That's what I was talking about before. Basically, they switched chain IDs in their initial launch, and that was one of the issues that we were saying, hey, watch out for this type of thing. I believe this had to do with the, I forget, it was I forget the exact issue that we saw last week with the exact method on the smart contracts that were the source of this, but it looks like that's the same thing that was happening here. I have a little bit of Monday morning brain fog. I can't exactly remember which function it was off the top of my head. Anyways, Blocksec warned that the issue might eventually cause the balance of the chain contract on the proof of work chain to be drained. Okay, so that could be a much more serious issue. Again, we've seen bridge exploits happen quite a bit. Bridge exploits are one of the largest categories of exploit in really all of blockchain. Okay, we've seen the Nomad bridge exploit happen earlier this year, the Solana wormhole, so many different bridge exploits, billions of dollars in crypto, and this could be a new, another example of that if this keeps up. So, anyways, the Ethereum proof of work developer said in a Sunday post the attack exploited by the contract vulnerability of the bridge and not their blockchain itself. Of course, that makes sense, but it was a problem because they switched the chain ID. They've contacted the bridge in every way and informed them of the risks. The bridge need to correctly verify the actual chain ID of the cross-chain messages, okay? So, what does this mean? Well, basically, last week whenever this was when we saw this warning pop up, my whole thing was like, hey, be very careful when you're using these brand new forks on a chain like this, for example, okay? So if you're actually going to go, make transactions on this type of chain, definitely exercise caution, okay? The other thing is, sometimes depending on how, there's a lot of people who are doing, airdrop hunting with their wallet on this new chain. It just really depends on how much you have and what you're planning on actually getting in order to try to extract value out of this, whether it's even worth it or not from a risk reward perspective. Because if you have a significant amount of crypto in your wallet, okay, and then you try to essentially get a redundant copy of that crypto on the new chain, and it's only worth a fraction of the price, is it really worth the risk of trying to transact on that new chain if you are potentially vulnerable to some type of, exploit? And here's the thing. I realize that somebody doing a replay attack is not necessarily, going to compromise your wallet in particular, but I think we're in a situation where there's so many red flags that, you know, sometimes in operational security, like, you just kind of don't know what you don't know. Okay. And we started to see all types of red flags around this type of thing, where honestly, like, I would be super careful before I tried to even really do anything with a wallet that had any type of real history inside of it on a new chain like this. So again, you know, it's not official, you know, financial advice or anything like that. I'm not trying to, like, you know, FUD anybody's assets or anything, but, you know, it looks, I'll just tell you what I personally am going to do. Okay. I'm going to be very careful around this type of thing. Now, some of this, you know, we've kind of seen coming, you know, ever since the initial announcement of this thing and the subsequent news that came out about them, like, freezing ETH funds and pools and stuff. I've always said that I'm not super optimistic about the long-term viability of some of the ETH proof of work forks. I'll have to see if they even are secure enough to withstand, you know, any type of, you know, network specific attack. Like, again, if they don't have enough power to actually defend the network, like, is the network itself going to be secure? Could it potentially be exploited? This was not an Ethereum. This was not the actual chain itself exploited. This was projects on top of it, but it had to do some initial design decisions, which made these possible. Okay. So let me know what y'all think in the comment section below. Are you using the Ethereum proof of work fork? Did you get any airdrops? Are you staying away? What do you think? Is it long-term viable? Am I just absolutely crazy? Let me know in the comment section below. Somebody says, has anyone else noticed a trend here? Bridges don't seem safe, and they keep being deployed and pushed. Why would anyone use the unsafe methods? Well, you have to think about the alternatives. Like, do you want to go to, you know, use a centralized exchange? You know, some people cannot use a centralized exchange. They can't KYC, or they don't want to KYC. You know, some of that could be obviously because they're bad actors, but some of it could just be demand for privacy. Okay, I'm not kind of conflate those two things for sure. But that's the big value proposition of bridges, is being able to move between ecosystems without, you know, giving your funds over somebody else where you have to KYC or even just custody them. Now I realize, again, yeah, we've seen exploits happen for sure. So there, you know, there's different, you know, solutions to this. Again, it's a trade-off. What do you fear more, or what can you not live with? I mean, you can always do things like, if you're bridging small amounts of money, there's less of a risk. Okay. And so if you do have a large amount of money on chain, then you can do things like diversify the amounts that you're moving on it into any particular ecosystem. Okay. And then, you know, sort of having a certain amount reserve that's not getting bridged, all that type of stuff. So there are some answers to these things. And long term, but I do think that bridges can get better over time. Okay, as we introduce more sophisticated cryptographic methods for making chains talk with one another. But for now, they still remain a pretty significant risk. And I mean, that's the other thing is, you know, I'm a pretty big advocate of the Ethereum layer 2 ecosystem over time for sure. And honestly, like, one of the biggest ways to get onto that ecosystem is to use bridges. So it's like, it's sort of like it's a tricky situation. So let's actually look at a couple more things. Let me just pull this up here. Speaking of Ethereum layer 2s, you know, everybody's always wondering what's next after the Ethereum merge. Okay. So we do have significant amount of updates in the layer 2 ecosystem. I need to go back and check on the news with Arbitrum Odyssey about when that's going to reboot. If somebody knows, let me down in the comment section below. But we're still seeing a significant amount of adoption in layer 2 space. Again, I'm looking at total value locked here. If you're not familiar with Ethereum layer 2s, again, this is creating a second environment where you can do a lot of your activity. You pay the fees in ETH. I pay the gas fees in ETH, but those layer 2s, they piggyback on top of Ethereum. So it's kind of like a blockchain, but it needs Ethereum to run, and you have to pay Ether gas fees. So like Arbitrum, Optimism, ZK Sync is another one, okay? And ZK Sync 2.0 is coming out pretty soon, so that's another big thing to watch out for. Let me just pull that up. So I want to just make an announcement of this because this is a big thing on the horizon, and we also have some other stuff around layer 2s. We saw an interesting. Let me just pull this up on. We saw this interesting anomaly happen with the Avalanche price on GMX over the weekend. So I want to talk about that too. It was pretty interesting. So anyways, we have a ZK Sync mainnet coming out in just 39 days. So basically about a month from now. So this is going to be the first roll-up based on zero-knowledge proofs with the ZK EVMs. That basically their new execution environment, okay, for smart contracts that uses zero-knowledge roll-ups, but also supports Solidity smart contracts. So what is that? So basically, ZK roll-ups. So first of all, you've got some of the main Ethereum scaling solutions right now, like Arbitrum and Optimism. These are optimistic rollups, but you have zero-knowledge rollups, which are essentially rollup based technology. So again, what's a rollup? It's basically where you take a lot of transactions and you group them together into batches, basically, or roll them up. Okay, and then that's what scaling is. You can essentially put more stuff in a smaller footprint. All right, so I'll explain scaling. So like, on Ethereum, right, you've got block space, and those blocks can only fit so many transactions inside of them, depending on how much data is actually contained in the transaction. So like, if I'm sending cryptocurrency from my account to yours, that's like one transaction, okay? And that gets grouped together with other transactions, like somebody else who's trading a token on Uniswap, okay? And those transactions get grouped together into bundled records called blocks, which are chained together to make up the blockchain, okay? That's what a block is. And so each transaction has a certain amount of data that it can contain based upon the block gas limit, all that type of stuff, right? So essentially, that's a certain amount of real estate that exists on the blockchain. And the more complex the transaction is, generally speaking, the more expensive it is, and generally speaking, the more data it takes up. So let's just, for simple math, say that you can only fit 100 transactions into a block. All right, that's not the number typically, but let's just use that as an easy number. So that means that your blockchain is basically bottlenecked on average by 100 transactions. So how do you accommodate more scaling? Like, what if you wanted to send 100,000 transactions per second? That's like, really big production level scaling. All right. So essentially what you could do is you could try to make your blockchain at the base layer accommodate 100,000 transactions per second, but that means that you would need to essentially, what did I say, 1,000 transactions before, or did I say 100? I can't remember. Let's just go with 1,000. You would need to 100x the scalability at the base layer, which means you need to increase basically 100 times as many transactions, or you could create the second environment, which basically lets you take, let's just say, all those transactions and then put them into a single transaction, like a big group of transactions, I'll say 100, and then, essentially map them to a single transaction that goes into the base chain. That's kind of like how you would do scaling with a second layer like that, okay? So with something like, zero knowledge rollups, with optimistic rollups, they get rolled up. Trying to define it without using the word optimistic. Let's just say in an optimistic way, where they don't have final guarantee of the validity until for after a certain, there's like a dispute window, I guess is the point I'm trying to make here. But with zero knowledge, what it can do is it only has to know if the transaction is valid, essentially, in order to put some sort of proof on chain. That's a much smaller amount of data. It's not the total information of the entire transaction. That's what makes it scalable. Basically, zero knowledge. So zero knowledge means you don't have to know all the information. You just have to know whether it's true or not, or whether it's valid or not in this case. And the validity of that is what gets included on the blockchain itself. And that validity guarantees that all these transactions that get included in that rollup are legit. And then the actual data about that is on that second layer. Okay, that's what the second layer for the layer 2 scaling is for. That's how a zero knowledge rollup works. Okay, and that's kind of a really rough way of explaining it, but I'm trying to do it in layman's terms where it makes the most sense. Okay, but so that's what ZK Sync is, and it's a ZK rollup, but it supports Ethereum smart contracts with Solidity. That's really important, because if you want an ecosystem to like ignite like wildfire, you know, blockchains get their value not just because of the network technology itself, but because of the actual ecosystem of applications built on top of it. So if you want to get a vibrant ecosystem up really fast, you need to make it easy to like copy existing open source projects and move them over to your blockchain. Okay. So a blockchain's only good if you can, you know, do things like have actual cryptocurrencies on top of it. Like ERC20 tokens, if you have a decentralized exchange on top of it where you can swap tokens, you provide liquidity, have all the normal DeFi applications that other people have. And so if you have to have some other programming language, then you have to reinvent all that stuff from scratch. But if you have a common programming language that all these other blockchains use, like Solidity for Ethereum smart contracts, and you can just essentially copy and paste those projects onto the ecosystem with relatively little effort. I mean, it's not just like easy, like not overnight success, but it's way easier than having to do everything from scratch. So anyways, that's what the ZK Sync 2.0 is all about, with ZK EVM. That's coming up next month. So that's a big deal, something to watch out for. And, you know, I'm super excited about zero knowledge rollups, especially over the long term. We will likely see many of the other layer 2s like Optimism and Arbitrum start to head that direction. That's my guess, at least, is that it won't just be unique players coming onto the scene to implement zero knowledge based solutions. It will be, but we'll probably see existing layer 2s head that direction over time. That's kind of the consensus among the community right now. But we need, you know, outsiders coming in to sort of put that pressure on the ecosystem to move in that direction. So, So speaking of layer 2s, we saw this come out over the weekend. So DeFi trader nets over $500,000 by using the DEX GMX to manipulate the Avalanche token. So if you're not familiar with GMX, it's a project over on Arbitrum. Okay. And so anyways, a savvy crypto trader deployed millions of dollars to manipulate the price of Avalanche's AVAX tokens on decentralized exchange GMX, taking up to $700,000 in profits using a strategy that exploited a basic loophole. So GMX, like other decentralized exchanges or DEXs, relies on smart contracts to match traders between these DeFi and between DeFi users. So basically, the trade allows users to trade spot and perpetual futures. But the loophole basically is that GMX offers trading to users at 0% slippage. So slippage is basically like if you go to Uniswap and let's say that you were going to like trade $100 of a token and then like quotes your price. And let's say that price was, you know, $1 per token. And then you just manipulate the numbers on there, and now you say, well, I'm going to trade like $10,000. Like you might see the price drop, right, or be more expensive. So maybe it's like now $1.01 per token if you're trying to buy. If you're trying to sell, maybe it goes into like 99 cents. That's slippage. So basically that means like the more the greater the volume, typically speaking, the worse the price, because essentially, that's how the automated market maker technology works. It works on a curve, and you're limited to the amount of liquidity that's provided in the pool. So GMX basically has zero slippage. All right. But all the pricing data from GMX is derived from centralized exchanges such as Binance or FTX, meaning the trader could buy a large amount of tokens such as AVAX in this case on zero slippage and rapidly drive prices up on centralized exchanges by placing buy orders on those venues and selling initial positions in GMX at higher prices. So essentially it's like doing an arbitrage strategy where you're keeping funds on each exchange and then watching differences and then buying and selling. So that is one arbitrage strategy in and of itself. I'm not saying that you should do this. I'm not saying that you should try to manipulate cryptocurrency prices. What I'm saying is that, that is one way to do arbitrage. Essentially is to keep a certain amount of funds on each exchange so that you don't have the transfer time between exchanges. And that's essentially what he's doing here. So this was pretty crazy. Anyways, they figured out what was happening, and they fixed it. Okay, but I thought this was pretty nuts. So this is also something that's been going around. People talking about a GMX exploit. This really wasn't an exploit. Necessarily, it wasn't like some of the hacks that we've seen in the past. But if you've heard people talking about GMX and what's happened over on the Arbitrum ecosystem, this is basically what was happening. Any ideas when they're going to reduce gas fees? Is that projected in the future? So that's a good question because a lot of people are disillusioned with the Ethereum merge thinking that it was going to fix the gas fees. It's not going to fix the gas fees. It did not fix the gas fees, but that's what these layer 2 scaling solutions are for, like I was talking about. This is basically where you have a second environment where you're required to use Ethereum basically, but you're in the second environment, and this is what reduces the gas fees. It makes it faster and cheaper to use. Someone says, do I do any mining? I don't really mine. Somebody says, what are the thoughts on Polygon proof of stake bridge and FTX portal hasn't had any issues? So I'm not saying every bridge has been exploited, and I'm not saying that every bridge that has yet to be exploited is going to be exploited. If you go back to what I was saying before, in my opinion, we still need bridges as a useful part of the ecosystem, and I think they can get better over time. So yeah, I mean, I don't have an overall. I don't want to say I was going to say I don't have an overall negative view of bridges, but that may not really be true either. I think there are pretty big risks with bridges, and I think they can get better over time. But now, I'll just put it this way: you got to be very careful when using them. Okay, so we'll do a quick review of the crypto markets here. And then we'll wrap up for the day. So, crypto, we're pretty in the red right now. All right, past 7 days have not been good. I think there's multiple factors at play here. We've seen, I don't know why I can trying to get my far column over so we can see the trend here. But every time I do that, the browser decides to like resize. It's pretty annoying. See if I can do this. Here we go. Zoom in. There we go. Awesome. How about that? Is that better? Anyways, it's not going to be perfect, but we see a general downtrend across basically the entire ecosystem with a handful of exceptions over the past 7 days. So Bitcoin is down back $19,000. ETH touched $1,300 yesterday within the last 24 hours. So I think the fact that we are seeing a common trend down in the space is definitely an indicator. Of course, we saw CPI data come out last week. It's the inflation data for the United States is not looking good. Again, the broader economy is all about trying to get inflation under control. The Fed raising interest rates, risk assets like cryptocurrencies doing poorly in this type of environment. And we're basically seeing no end in sight for that type of thing. And that's why I think we're seeing all of crypto sort of headed on a downtrend. Now, that being said, ETH looks like it has corrected harder. Percentage-wise, that the slope is, more sharp. It has a greater slope downward. Again, you can't really see it on my screen here. Compared to like Bitcoin, said another way, the ETH BTC ratio is back down. I think some of that's got to do with the post-Ethereum merge sort of dump in this case. I mean, we talked about for weeks and weeks and weeks and weeks ahead of the Ethereum merge that we could definitely see a sell the news situation on Ether. And I think some of that is to explain the additional sell-off in Ether post-merge. So where's the bottom on all this? It's hard to say. Let's take a look at the markets when we get closer to our previous lows. That'd be about, $900 for ETH. That would be about, I think $1,600 for Bitcoin. Let's first take it one step at a time, see if we actually hit those levels. And if we do, what happens when we get there. Let me know what y'all think in the comment section below. Somebody says the Fed's getting together the next 40 hours to discuss inflation. Yes, that's definitely a thing to watch in your calendar for this week because we have the Federal Open Market Committee meeting, FOMC meeting later this week. We're going to find out what they say. Press conference from Jerome Powell afterward. And that'll likely have an impact on the markets this week as well. So, all right, everybody, that's all I got for today. As always, smash that like button down below for the YouTube algorithm. Subscribe to this channel if you haven't already. That really helps these videos out so that more people can learn about blockchain. And if you're as fascinated with this technology as I am, you want to get your hands dirty, how can you get started today? Well, you can go to my YouTube homepage. You can find those free courses there. They're like Udemy courses, but they're totally free. And if you like those and you want to take the next step, or hey, maybe you take a master's shortcut entirely, I can show you how to master blockchain step-by-step, start to finish, over at dappuniversity.com/bootcamp. You don't have to be an expert to get started today. You have to help people with zero coding experience become real-world blockchain developers in a matter of months. So that's all I've got. And until next time, thanks for watching.